The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hello there, and welcome to Talk Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. So, George, summer's over, news flow starting. How are you feeling about it?
Hey there, Ian. Lovely to be back and chatting. And although summer's over, here we're having this amazing Indian summer. I don't know if that's a metaphor for anything other than the weather today. It'll probably rain again tomorrow. But what's generating interest for you this week?
I suppose it's a bit like the weather for me of the last week or so. I've been looking at Gamma and IQE, two companies that show that it's not just about tech with tech companies, but it's also about the business model and your position in the value chain. Gamma, strong set of numbers, excellent cash generation. They've made some acquisitions, but those businesses are not only adding to the top line directly, they're also seeing some cross-selling. And it's also increasingly clear with this business what they're doing with these acquisitions in terms of bringing in access to the likes of Ericsson, LG, and better access to the products of Cisco to be able to offer a better set of products out to their enterprise SME customers. We have the slightly odd situation that this business is getting a lot more complicated, but it actually gets a lot clearer because we're talking about what the customer wants done, how the customer wants to use their products, the fact that the customer's products can actually be easily demonstrated to investors too, as opposed to a few years back when we were just talking about SIP trunks, cloud PBXs, acronym city.
Ian, is there a change in the buyer whereby buyers are looking for fewer throats to choke from a supplier side? And is that then in itself driving business model changes as well? So moving from a market characterized by point products to now looking more like suites and platforms?
There are these big players out there who are saying, look, we are really interested. This is what matters going forward in technology. It's all about communication. That's why the likes of Ericsson and LG have got the product range they have, the sort of SME. That's why Cisco have in recent years invested very, very heavily in products like WebEx. But for customers, they all really just want to deal with a trusted company that comes to them and solves their problems. And when you look at Ericsson, Cisco, Amazon, Microsoft, whoever's in this market, they just don't have the capability to have that kind of level of service. That is why we have channels to market for technology companies.
Yes, but Ian, but at the same time, you could say, well, do they even want that level of customer support and service? Because that means you're bringing in professional services, but you're also diluting margins. Has that been the story at Gamma? Have you seen any evidence of that?
No real evidence of any kind of dilution of margins for this business. It's still a high margin business.
Yes.
Customers still want it sorted and they know where to go. Well, it also has to be said that the channel partners, the smaller players who go in and serve the SMEs, because the SMEs don't deal directly with Gamma, SMEs go to small channel providers who then come to Gamma. And the clever bit that Gamma used to drive growth was the fact that he was incredibly good at servicing these small channel providers who went out and built up their customer bases of SMEs.
Yeah, but Ian, it's hard to do it in terms of putting together these sort of in a box or turnkey solutions. They have to have, inventory. So you've sucked up, working capital on that, but you've also have to have the smarts from a people side to put the solutions together. There's a lot going on in that kind of transition.
You do, but step back and think this is still a recurring revenue business.
Yeah.
This is still saying, okay, we have to put some effort in at the start and we have to put in effort at occasional instances along the line. But still, the vast majority of revenues for this business, it's a recurring revenue business.
Because of that, are they at the stage where they're giving you data points on LTV and CAC conversion? Are they making themselves look sexy because they now have recurring plus a better expansion rate?
Do they fall down the SaaS trap, shall we say? No, I think they've been quite smart not to fall down the SaaS trap.
I told you to stop looking at SaaS valuations.
Yeah, it must have been tempting, but no, they've been very good at saying, look, this is what our business does.
Okay.
IQE, something of a contrast, really. The gallium arsenide, gallium nitride, epitaxial services, laying these tiny atomic level layers onto semiconductor wafers. Very, very high tech, very, very sophisticated, but it's still making losses after all these years. It's evidence that great tech doesn't make a great business. But I don't want to be too damning with that, because in terms of history, this business did actually start out as an outsourcing business when Drew Nelson put it together. The problem that the company has is that although it has all this IP, it is now, because of the growth in outsourcers of other services within the semiconductor industry and the sort of mainstream manufacturing of gallium nitride, gallium arsenide chips by foundries, it now becomes an outsourcer to outsourcers. With a large fixed asset base, it means it's really got no ability to pivot. It's stuck really demonstrating all the sort of dynamics of the semiconductor companies of old with their fabs, where they had new technologies all the time, new applications, lots of unknowns, lots of exciting things to talk about, which meant that stocks in the semiconductor industry were stocks for trading, not really for stocks for stick it in your portfolio, dear, and come back in 20 years. Boom and bust is inherent in this, which is tough on the companies and particularly tough within the UK market.
Ian, does being the outsourcer to the outsourcers, does that help in terms of smoothing that through the cycle curve, do you think?
If you want semiconductors made, it's great. But if you want to make semiconductors, it's not so great. If you're the semiconductor vendor, you've got a great situation in that you've got this foundry who has effectively smoothed out some of the lumps for you because they're taking the CapEx hit. And then for the foundry who may or may not want to outsource part of their process, you've got IQE further out who's taken even more of the volatility out of it.
Yeah. But also looking more broadly, the play has been NVIDIA. How does IQE dovetail into the current cycle?
They will say that they have some exposure to the whole AI story through high-end computing, through the connectivity sort of products. Really, it's difficult to make the case from what's coming through in the current numbers about that.
I mean, the positive of NVIDIA is that hopefully it'll tell investors about this wide universe in the semis and hardware industry. From a sort of a valuation, perception area, who has done better?
Who has done better? Well, one's worth 150 million, the other one's worth 1.5 billion. One's been listed for 10 years, one's been listed for well over 20. As I say, one's a great stock, one's a great business, which is a shame because there's been a lot of work and a lot of intellectual effort gone into IQE over the years.
If you were starting a semis business yourself, where would you be focused?
Probably at the edge.
Join the crowd.
Join the crowd.
So what has IQE said about the edge then?
Well, the edge comes back in to sort of me doom saying that the wireless side of the business is all a bit dull because no one's interested in mobile phones at the moment. But that's going to be where the communication is. Back to that again. Within the technology industry, within any kind of computing function, the computing power sort of cycles between the center and the edge all the time. It's just the way it works. And it's been like that for 50, 60, 70 years.
As I look to my own crop of companies, Ian, the story for me for the last few weeks has been the pivot from Q2 in the US reporting to UK interim results reporting. We've had a huge flurry over the past couple of weeks. I'm going to start with Computacenter. Today, Computacenter putting out a little RNS, cancelling shares. Computacenter has delivered 19 years of unbroken EPS growth. Now, Ian, as you know, for the tech sector, that is unheard of. In addition to that, Mike Norris, the CEO there, he celebrates 30 years at the helm this year. Again, wow, amazing. Longest serving FTSE 250 CEO. Anyway, they posted interim results, gross profit minus 5%, adjusted PBT minus 26.8%. Suddenly, the dream of 20 years of unbroken EPS just seems to be drifting far away. However, they're buying back shares. They've got 140 to spend. They've spent 60 in H1. Now, as we know, with that, they can reduce the denominator. From a technical side, adjusted tax rate helps in H2. In addition, from the operational side, the industry analysts at Gartner and IDC, they're pointing to a recovery in spend in terms of the infrastructure services side. Budget flush season this year helps Computacenter. I think it'll also help them in the US, where you've got an election there. So you would normally expect corporates to just, let's hold on and see what the result is there. And that could accelerate spend in that crucial 2 weeks of the financial year. And of course, as we remember our tech, we know that Computacenter typically has early RevRec stuff. Now, the plan only works as long as the share price remains low. The last thing they want is a share price to go up because that blows the plan out. Also on the Hydrama side, we had news from MadeTech this week. They signed a government contract. The story in here is really about what that sort of cohort of companies has been saying. So chiefly, Kainos downgraded on the 2nd of September. We also saw last week a warning coming through from TPX. So as a consequence, MadeTech share price has been under pressure. So they needed a piece of good news. And I know at the end of this short little RNS, giving the details on the contract, CEO Rory MacDonald says, the award of this contract helps underpin our revenue expectations for 2025. So bless him, he's managed to quickly drop in a short little trading update at the end of his product news.
There's no news like no news.
What's on your calendar for next week, Ian? Anything exciting?
Calendar for next week is the Day of Judgment with Raspberry Pi. If that doesn't come through, it's hard hats all round for UK small cap, mid cap tech, isn't it? Given the nature of the business and the sort of cycles it works to, I would be relatively confident that it should be all right. It's about driving the sales line over the next few years, as far as I can see.
On a provincial basis, it has drifted back from the enthusiasm in the immediate aftermath of the IPO. I don't think in itself that's telling us anything about the results. It's just people have taken some money off the table that they've made.
Yes.
Because we both love our sectors so much, you would say that any banker going into an IPO would have beaten the company up so much that they cannot miss their first set of results. Whereupon both of us go, oh, hang on, remember CAB payments last year?
Yes. I don't think that the geographic exposure for Raspberry Pi is quite as risky as we saw at CAB payments.
That is absolutely the truth. But they did miss just after their first set of results because they came out with a positive trading update in the aftermath of the blackout period. I love how that rolls back into Gamma. And what you're saying is that long-term, consistent delivery, understanding the expansion rate at customers. Good call, you.
It's a long-term game, as they say. But as I said on IQE, there are good reasons to be invested there. And don't think that those people who are invested in IQE only have IQE in their portfolio. They do have some kind of diversification.
Very good. Great stuff. Ian, lovely to chat again. Looking forward to the week ahead already.
Fingers crossed.
Brought to you by Progressive Equity.